Very good morning and a very good morning and welcome to our webinar on the resilience of balanced funds. I'm your host today, Donovan Chetty, and I would just like to start off this webinar by extending a heartfelt thank you to the many of you who have supported our suite of funds here at STANLIB, and more especially given that we will be focusing on the Balanced Cautious Fund today. Thank you for the strong support that we've had for this fund over the many years. It is a sign, it really is a sign of your trust in us as stewards of your clients' capital, and is something we really don't take for granted here at STANLIB. Now, on the call with me today is Henk Viljoen and Kobus Nell, senior portfolio managers in our multi-asset franchise. Good morning, gents, and thank you for being here. Really looking forward to the discussion today. Now, I'm aware that balanced funds have taken much slack over the years, especially during the pre-COVID times where local equity seems to have forgotten its age-old relationship with risk, as cash outperformed local equity over 5 years in the periods between 2015 and 2020. Coupled with that, the limits on the offshore allocation because of Reg 28 has caused, or rather exacerbated, your frustrations, as offshore markets seems to rise faster than our politicians on a point of order in Parliament. So this sort of prompted many to rethink the use of balanced funds and its relevance to deliver a desired outcome, choosing to do their own asset allocation with a preference to offshore markets given the stellar performance. Fast forward to present times, and the picture looks vastly different. Firstly, Reg 28 has changed, and fund managers can add much more offshore assets than before. Local equity is thriving, largely because of the commodity sector, but nonetheless thriving. Cash is yielding you a negative real return given this inflation soaring, and offshore markets have come off quite significantly given its all-time highs last year, albeit a favorable number compared to SA equity over the long term. What this reveals to us, well, at least to me, is that the markets really do move quicker than one can ever anticipate. And if you are heavily weighted to one specific asset class or sector or style for that matter, the risk that you carry is quite huge. This is especially true when risks have significantly increased in the marketplace currency, thinking about Russia, Ukraine, the rising inflation environment. You see China is in lockdown because of COVID. And so the question must be asked to the audience today, and I'm asking this as well, is have we constructed resilient portfolios for our clients over the long term? How have we considered risk when we think of return? In other words, have we constructed portfolios that not only participate in short-term growth prospects, but also for the long term when market dynamics change, and at the same time constructing portfolios that have the ability to absorb shocks in the short term, which can be extremely value destructive for our clients? And I think that's kind of the questions we want to look to answer. And I think the Balanced Cautious Fund that Henk and Kobus are going to be talking about today answers a lot of those questions quite nicely. Henk and Kobus are going to have about 45 minutes to demonstrate this value and sort of answer those questions that I've sort of posed. And we'll then have about a 15-minute Q&A session. So please do use your Q&A function at the bottom. We will endeavor to ask many of those questions to Henk and Kobus. If they're not answered during this Q&A time, we will definitely get back to you via your STANLIB BDM. So that's the housekeeping. Enough from my side. Over to you, Henk.
Morning, everybody. Let me just share my screen here. Morning, everybody. It's a privilege to chat to many people out there. I think in the very short term, obviously, we've all been very challenged with what has been happening in our world, and there's no doubt that the current world that we find ourselves in, with a lot of volatility, is certainly causing people to be very concerned about their investments and to be very worried about where or what they should be invested in. And maybe hopefully myself and Kobus this morning will be able to address some of these questions to yourselves. So when we look at the fund we're talking about this morning is the Balanced Cautious Fund. And I think many of you know this fund, and my idea would be to maybe use a bit of a reverse order and to start with a slide that we typically close our presentations with. And this is the long-term performance of this fund on a rolling basis over CPI +3. And I think the important message we want to demonstrate here is that this fund over time has the ability to do well, and there will always be funds that will deliver higher returns in higher risk environments. But we really are confident that this fund will see both your capital appreciate, but also protect your real return over time. So when we look at this graph here, we can see that over the period 2018 to 2021, when we saw local and international equity markets basically move sideways, this fund battled to be above that benchmark. We now know that since the crisis that happened with COVID, real yields in South Africa particularly became very attractive. So we have the ability to invest in bonds in this fund. And we also have the ability to obviously take a portion of the funds in this fund. And that, just to be clear to the audience, up to 40% of this fund can be invested in equities. And we've chosen at this point in time to be basically half invested. And if I could just maybe take a step back. So what we've done year to date is we've invested some money in the early part of January, when we saw the first big correction in US equity markets and the Rand surprisingly strengthened into January. We moved some money into global equity markets. And we also at that point in time moved some money into fixed interest. Subsequent to that, we added to fixed interest, and we've also very recently added a little bit to SA equities. Now, Kobus is going to talk specifically about our global view and the view that we have on the two different equity blocks. So I'm not going to dwell any further on that. But I think what is important here is we're trying to give you a performance that over time does mean that if you were invested in a very aggressive portfolio and have been benefiting from global equity markets in particular, I think we've been promoting the idea that you move some of that risk back to a lower risk environment where you are less exposed to equities, but still have some equities. And we all know that we live in a world where interest rates on the other hand of the spectrum have fallen to very low levels, and that the typical real returns that you've achieved from that side has not been materializing and are likely to not be the case given what is happening to global inflation. So we'll spend a little bit of time today to talk about inflation. But when we now take a historical snapshot of what this fund has done over time, and we compare that to the different asset classes, and if we start on the left-hand side there, you see that Johannesburg Stock Exchange over time, you've got two bars there. You've got the blue that gives you the average 10-year return, and then the volatility of these asset classes. And it's surprising to look at the very next asset class where you have seen huge volatility in property, but over time, property has certainly turned out to be an asset class that does offer good returns at times, but on a 10-year average has not done very well. Bonds has been the stalemate. And if we just immediately then jump to the right-hand side, for the same volatility that you've seen in bonds, you've basically seen returns of roughly, call it 13.5% over time in the Balanced Cautious Fund. So you can obviously move through all those different assets that is on the spreadsheet. SA cash obviously has got a very low volatility and is always attractive. But if you want to have that real return, which we all need in terms of beating inflation over time, seeing our money grow, but not necessarily taking huge risk, we really think that this building block is a very appropriate place to be invested. So without dwelling into more detail, I'm going to hand over to Kobus to then talk to you about the equity blocks, and I'll talk to you a little bit later around fixed interest and the construct of the fund.
Thank you, Henk, for the introduction, and good morning to everyone. So firstly, I think we want to deal with the Russian invasion into Ukraine. Obviously, a very extreme set of events that played out, and it's got far-reaching implications on so many people's lives. And yeah, and in the day we're living, we would have thought that things would have escalated to this point. Second is the economic effect now for the world that this is brought forward. So firstly, we want to sort of look from a price effect, what has happened since the invasion of Russia into the Ukraine. It's caused a major spike in energy prices, and that's in the likes of oil, coal, and gas, and also in the likes of other commodities, in particular soft commodities, which obviously plays through into food prices. And the Ukraine, from a production perspective, if you take sunflower for argument's sake, it's about 25% of global supply in the tradable markets. And many of the other commodities, sort of wheat, etc., is around 10%. So you talk about a material disruption in supply of commodities, and in particular soft commodities and energy prices. And one would ask, what is the relevance and the potential impact of that potentially? So firstly, it's just loading another layer of inflation on an inflation point that's already been extremely elevated. And we'll touch a little bit more on that later. That's sort of the first effect. The second effect is the concern that it will have on your mid to lower income level consumers in the way that they will be subject to these increased food prices and general energy transport prices. And that, again, in its way, can take a massive part away from the discretionary spend that is potentially available. Second to that, we've seen a massive corporate exodus out of Russia. And I think this is a theme, during the last couple of years, that a lot of corporates and investors has become a lot more focused on the ESG topic, doing the right thing. Obviously, a lot of these companies has exited the company at the expense of profit, but doing the right thing as they considered them. The impact on this and on the Russian economy is obviously still very early days and still to be seen. But the biggest challenge probably for the global environment here, and that's probably the one that we want to focus on today, is on inflation, the effect it potentially will have on inflation, the effect that spike in these commodity prices, energy commodity prices, will have on growth. And remember, if you look at recent years, when we've seen a single year where oil has doubled, also in years where we've seen very high wage inflation, about 5.5%, we've actually seen a recession following those kind of price moves. So it's an inflation worry, but also a growth worry at the moment for the global context. I think also importantly, since Russia has been removed from the global settlement system SWIFT, they have reached out for different settlement arrangements and looked at different options. And obviously, they are also looking for new supply chains for their product, both energy and commodities. And they have been reaching out to the eastern side of the world, in particular China, to try and facilitate in those regards. It's clear that Europe has turned really their strategy away from dependence on Russian energy. It's obviously not something that can happen overnight, and Europe is still extremely dependent on Russian energy, but it's something they want to scale down and with quite a lot of urgency. So I guess the key points now to watch from here is to what extent the war and developments around it can escalate. We've heard that the Russians have been reaching out to the Chinese for economic and military assistance, which they have not denied, and my understanding is are considering. And the US is clearly taking a massive negative stance to these potential actions. So there is clearly in the background building a much bigger geopolitical risk environment that I think is relevant and important. Further out, many people ask the question to say, how sheltered is the US with regards to all of these developments? I think the one thing to watch, and it's probably something further out, is that if Russia do reach out and some of the other countries agree on a different settlement system outside of SWIFT, then the US dollar as a reference currency may lose its relevance, and you may see a more diversified monetary base globally. The question then, what you can ask is, with all the debt, with the US debt that's sitting close to 130% of GDP, where will the funding of that debt come from going forward? And if you don't have funders for your debt, the obvious thing is that you can see your yields actually ratcheting up. It's clearly a consideration, not for now, not a major challenge as we stand here today, but I think it's something that one has to watch going forward. So then maybe just to talk a little bit about these big changes we've seen in commodity prices, and just as a reference, when you look at the price moves we've seen year to date, coal is roughly 130% higher. The likes of oil and gas around 30% higher. So it's material moves that we've seen. And obviously, some of these emerging market countries are exposed to different sides from an importer relative to the exporters. On the right-hand side, as you can see, the green bars shows the energy commodity and products in terms of how that is actually facilitating their trade surplus or the other end of the curve, loading a trade deficit on trading terms. South Africa is in a very, I would argue, unique position, and a fortunate position from that perspective, that we have quite a bit of coal exports. And to some extent, given these coal exports and that the coal price, being a fossil fuel, is linked to the price of oil, so fossil fuel, that there's some sort of hedge for us in South Africa as we export coal at higher prices. When we need to import oil at higher prices, it has a neutralizing effect on our terms of trade. A big benefit that South Africa has benefited from, in particular, is the precious group metals. Those are the likes of the platinum, palladium, rhodium, being the three key metals within this precious metal complex. You can see the level of these prices and to what extent these escalated prices has contributed to the fiscus of South Africa, both in two ways. South Africa charges royalties on revenue lines in many cases. So the higher your revenue line is, the higher the royalty is that the government charge and actually adds to its top line or revenue line. Second to that is the normal corporate taxes. And we've seen these companies benefiting from these very elevated prices in extreme profit levels. So both those has contributed to a great extent in the so-called windfall revenue that the fiscus has enjoyed. And that's been massive. Over the last 2 years, give or take around 200 billion rand, depending on what you consider as a midpoint level, that the fiscus has the benefit of enjoying that inflows. And obviously it helped a great extent of lowering that debt to GDP trajectory, which Henk will touch a little bit more on later. I think it just emphasizes a more constructive view on South African bonds as well. So the key topic, I think, which markets are pivoting around, and even before the Russian invasion into the Ukraine, was inflation on the one hand, and how will the Federal Reserve in particular react in terms of interest rate increases. So if you look at that headline inflation number of around 8%, then about 5% of that number is items that are not directly related to energy. So those will be the price increases of services, which are obviously a great proxy of wages and increased wages in the market. And that's a key worry. That's a key worry for the market. So about 2.5%, call it, from that 8% number came from increased service prices of services and wages. And that is the concern, that those inflation drivers are more sticky. Other part, another 2.5%, that brings you up to about 5% of that 8%. It's probably attributed to goods. And throughout this COVID pandemic, we've seen major restrictions in the flow of product. A lot of bottlenecks, supply inefficiencies globally as many governments have shut down, restricted access. That has caused also another layer of inflation on the price of goods. Now, obviously, it's been exacerbated by the massive stimulatory, the fiscal stimulatory program that the US has given to its people, and how it has actually propped up demand, actually boosted retail sales, probably to the tune of $100 billion in excess of the trend level. And both those had a big impact on inflation. And then away from that, you've got your food component and your energy component, probably in the other 3% or so. And that is the key worry now, specifically in those two components, in energy and in food, that one can see further price pressures because of these sharp increases in hard and soft commodity prices. So the question is really, how will the Federal Reserve now respond? We've seen in the beginning of the year, when the market expected as much as 7 to 8 interest rate hikes of around 25 basis points each by the Federal Reserve, that the markets have really traded to a position of a lower risk exposure. So the markets has effectively seen that as a bearish indication. Despite the underlying earnings growth still being strong, the US consumer still being in a very comfortable position, given its wealth levels, its ability to access more credit, and how employment there has progressed. The complication that these higher prices, and as I said, the speed at which these prices has increased, has caused a lot of worries now on global growth. And not just on slow global growth, but more so on a potential recessionary environment playing out the end of this year into next year. That extends probably from Europe, which is very dependent on energy and Russian energy. Again, if you look at Europe, it's maybe important to mention that of their inflation rate of around 5%, about 3% has come purely from energy costs, increases in energy costs. So Europe, a lot more exposed to this inflation trend. But be it as it may, the growth concern, recessionary risk on the one hand, and rising inflation on the other hand, which makes it a very, very difficult environment for the Federal Reserve in terms of interest rate policies and how aggressive it actually can be in this environment of hiking interest rates. So the market has scaled down these expectations on interest rates quite dramatically. It's probably sitting, the 7 odd hikes we've seen the market as priced in, so dropped to around 3 to 4 hikes now. The key question that one's got to ask yourself is, as I said, is these rapidly increasing energy prices, commodity prices, and the effect it has on inflation. So this big spike on inflation, can that actually cause a recession in itself? Because the rate of these price increases is so fast and so big that it actually causes a massive demand destruction in demand. Or on the other hand, if the Federal Reserve respond too aggressively with interest rates, it can very quickly dip the economy into a recession. And we've seen previously the key reason for the US moving into a recession was because of interest rate hikes by the Federal Reserve. When we look at our global and domestic equity market, and for the reasons I mentioned on these increases in commodity prices that South Africa benefited greatly from, all the material companies that are listed on the JSE, and you can see the contribution from earnings towards the overall market has gone up to almost 45%. If you look at it from a trailing basis, and that has been on the increase from, say, around 15% back in 2016 at the cyclical low point. So this has been our market has been a great benefit of these high commodity prices and the way it fed through into increased earnings. And this also drove our whole earnings outlook and our earnings expectations up massively. out of this COVID pandemic. The question that one asks is, you are dealing now here with a very concentrated component with regards to our earnings base. That's the first point. And secondly, it is subject to cyclical, highly cyclical factors, one would say. Yes, there are strong, one would say, more structural drivers at this stage, the whole greenification and the investment into a greener environment, which got a lot more demand for in particular base metals. And the lack of investment again in fossil fuels like coal and other type of mining commodities. And both those has sort of both from a demand, the longer structural demand perspective, given a better outlook, but from a supply perspective, also challenged it a little bit more. The problem is, if the world is heading towards a recession, and then those kind of arguments are all out of the window, because generally speaking, the impact on demand out of a recession is so great that it just stumps these positive effects that one say. And it's a highly cyclical part of the market that can react very aggressively. And I think it's just very important to understand when you talk about investing in the JSE in South Africa, in our equity market, that it is a concentrated market. The second key question is the regulatory 28 changes and the potential benefits that it can have for investor. Now, obviously, and maybe just to say as a start to refresh you that the limitation on Reg 28 funds has been the maximum of 30% offshore investment, and then they allowed additional 10% to be invested into Africa. With the latest budget, it was announced that difference between Africa and offshore is scrapped. So you are talking now about a maximum of 45% offshore. So the 30% maximum offshore has been increased to 45% maximum offshore exposure. And that's a big change. It's a very, very big change. And we were surprised, actually, to be honest, to see this. One would have thought this would have come through more in gradual increments. But what does it mean, I think, is the key question here, and this increased potential allowance or the potential to allocate more money to overseas markets or global markets. So the exercise we've effectively done is when we look at our mid-TA or SAA strategic asset allocation for the Balanced Cautious Fund, with that 30% offshore exposure. And obviously, if you can either move up or down the risk curve, introducing more risk and make the fund subject to higher returns, or move down the risk curve. And that's the plus and the minus risk points that I've showed on this chart. But if one introduce at the same level of exposure of equities, bonds, individual asset classes, but you just allow that higher percentage of offshore allocation up to 45%, then it's effectively shifted this efficient frontier. And again, efficient frontier is just the return per level of risk points across different options. It shifted this curve up to a point now where you can see that effectively, if you have been invested at a 45% global allocation opposed to just a 30%, then you would have been able to achieve a similar return, but at a lower risk level or a lower volatility level, or you could have enjoyed a higher return level at a similar level of risk. And this has historically been the benefit from having a higher exposure to global assets within a balanced fund, within a global balanced fund. Now, obviously, it is not as simple just to say that, go out tomorrow and it's, just go maximum out. There's many considerations that one got to take into account. And one of the very important consideration is the level of the currency, of our domestic currency, the rand, against other hard currencies globally. To give you an example, just recently during the pandemic, when the rand effectively sold up to about 19 rand. And at that point, you panicked and you said, you know what, I just got to push as much as I can to offshore sources. Then you kind of locked in at that 19 rand level. And then subsequent to that, we've obviously seen the global flow of capital returning and more normalizing in some other way. And by the way, if you look back at the rand, it's been depreciating around 5 to 6% between the dollar against the dollar and the euro since 1995, probably. So it's been quite volatile around that, but over this long periods, it's actually giving you that hard currency pickup in returns. The problem is if you are entering at the very extreme point of where the rand trades, you are penalizing your future returns massively. And I think one's just got to be conscious of that, of what is a fair level of the rand before one consider these type of changes. The second to that is that I won't dwell too much now into it, and we can maybe get later onto it if there's time, but there's many benefits of allocating towards global markets, away from just the normal elements. As I explained, it's obviously a much more diversified market. It gives you access to those structural growth drivers. So from our side, as we've started to diversify away from the US, the global equity component, where the US equity market actually dominates, more into Europe and more into emerging markets as well. As we've seen, the valuations for the US market has become very extreme. Of late, GES has cut back with the latest sell-offs that we've seen. But as it is that we've opted more for a broader and diverse exposure, and there's attributes, I think, in these other two areas of the market, as I mentioned, the European and the emerging market side as well, that one can consider. I think one of those considerations that we certainly had in mind was that normally out of these recessionary periods that you've seen, the emerging market earnings recovery, that reflation trade, has been extremely responsive. You can see that sort of the, what do you call it, reddish line on this chart. So you can see back in post the emerging market crisis, we had a very strong response. Out of the global financial crisis, we had a strong response. The commodity crisis back in 2015, out of that, we've had an extremely strong response. And of late, we haven't really seen that playing out again. So it hasn't really performed towards the potential, certainly that we thought it could deliver into. Now, some of the challenges that I think emerging market and more so China had to encounter was a much more complicated COVID environment with regards to a lot more restrictive lockdowns that they implied. And the second negative effect was the increased regulations that it effectively applied into the market. That's caused downgrades in earnings and effectively having this effect. I think it's fair to mention at this point that China is probably the only region or country in the world now that is embarking on a expansionary liquidity policy. So it has been very responsive and supportive from various aspects to try and support that economic growth number of around 5.5% that they got in mind. And we've clearly seen that last year was a period that they've actually pulled back credit. And to the back end of last year, we started to see signs, and certainly in the beginning of this year, that they're expanding their credit policies again. So it's just something to watch and how it can actually play through from the current levels where we are in terms of earnings and valuations. Also, I think another very topical question that's in the market is the style of investment. Now, last year, and certainly the beginning part of this year, has been very favorable for value companies. And those value companies, in many cases, has been companies that are poorer quality companies, that has got lower growth attributes in many cases, and that can be highly cyclical as well. So with the extraordinary stimulus that we've seen from governments, and specifically from the Federal Reserve during last year, that we've seen the US pumping in this extreme levels of money towards the consumer in terms of interest rate policies, etc. The tide was strong enough to lift all boats effectively. And that's when we saw a very aggressive response in value shares relative to the so-called quality and more growth, higher growth shares. Where we are now, and that is our view, given the turmoil that we've seen in the world, given the challenges we have with regards to growth in particular, that we are of the view that the market will start to trade back again into quality exposure and prepare to pay up more for growth exposure. So with that, I'm just going to leave it here. I'm happy to take questions a little bit later on, but I'm going to hand you over to Henk now again, that can talk you through the fixed income part of our portfolio, which is a very important part of this fund. And he'll just talk to you through some of the details there. Thank you very much.
Okay, everybody can see me. Yes, thank you, Kobus. I think that was very insightful, and hopefully that does give everybody a really good view on how we think about equities and all these challenges. And as I think we said to ourselves at the beginning of 2022, it was really going to be a year in which you had to strap yourself in for the volatility. And if we look at the volatility of even very, very large companies like Naspers Process in the last few days, it certainly has not disappointed on the volatility side. So how do you manage your money in an environment where we have such large volatility? When you look at this fund, and obviously one of the things that we are very deliberate about in constructing this fund is to be very conscious of the opportunities to create real income for our investors. So we basically use 4 building blocks to achieve that. So as a house, we've been very positive SA bonds, and we carry a relatively large position, and compared to our peer group, in many cases, a much larger position in SA bonds. I'll dwell a little bit into why we believe bonds are a good place to be invested in a moment. Then we also have inflation-linked bonds in our portfolio. Now, I would just like to take a moment to talk a little bit about inflation-linked bonds. So as we stand today, the general expectation was that inflation are likely to be in the region of about 4.5% over the cycle, talking about the next 2 to 3 to 4 years, if you look at what most economists predicted. Looking at the latest numbers from Kevin, he's now looking for inflation to potentially push up towards 7%. Now, although inflation-linked bonds actually trade quite expensive relative to nominal bonds, inflation-linked bonds have always had a bit of a premium, and we really believe that as the high monthly increases come through in inflation, that inflation-linked bonds will actually turn out to be quite a good rewarding asset class. However, would we be holding inflation-linked bonds perpetually in the fund? Probably not, but certainly we acquired them last year. Inflation did phenomenally well, basically doubled the performance we got from bonds. And so far, year to date, we think that inflation-linked bonds is a little bit of an off-benchmark bet, but certainly is a kind of asset that we like to hold in our portfolio for our investors. Then we also, obviously, in order to complete the conservative block of 60%, have many other opportunities. And what we've done in the offshore block is we hold a small offshore bond, but our main holding is with a company called Brandywine. Now, it sounds like quite a festive crowd, but they're in Philadelphia in the US and invest mainly in emerging markets and emerging market currencies as a proxy for what is available in their valuation model for assets to be invested in globally. Obviously, one of the risks is that if you ask me, would I want to be invested in global bonds today? Probably not, because we've certainly seen many of the DM markets push up, and the likelihood with interest rates rising is that they'll push to higher levels. But in many cases, emerging markets have already made adjustments to monetary policy, And we think that the growth in many of the emerging markets will imply that the current yields that they're offering would be probably maintained. And therefore, we are not totally unhappy with having an exposure through Brandywine into a global emerging market / opportunities in currency fund. And then, as all funds do, we hold a cash portion. That cash portion at the beginning of the year was north of 10%. We have made some investments, as I indicated earlier. And fortunately, this fund is seeing quite material inflows, and the cash portion has already moved up towards the 8% level as we stand today. So let's move on to bonds. A large block of our portfolio is in bonds. And as a house, we've been very optimistic that bonds does present a good value opportunity. Now, what we're looking at here is a slide that is a basic breakdown of how you ask yourself whether the value of the SA bonds is a fair reflection of the underlying building blocks of what the value should be made of. So the blue bars at the bottom is the US 10-year, and obviously that's moved a little bit higher recently. Then we have the gap between US and SA inflation. Now, at the 4% level, that's a historical average. And we do know that if you look at the market today, the market is actually now inverted, but over a longer period of time, we've seen that positive differential, and we are happy to potentially go with that. Then the red bars are the CDS spread. Now, what is the CDS spread? The CDS spread is the spread at which SA dollar-denominated debt trade over equivalent term US debt. And that's basically the risk premium that your country carries, and that has been around about the 250 basis point level. And then obviously you ask yourself, where's the actual level in the market of the bond? And that compares then to a spread, which is that gray bars that you have on the top of the bar. So when you look at 2013 to 2018, those gray bars were below this, the line, and it effectively meant that the bond yield, which is the red line, traded at a premium to the valuation model. And why was that? That was the time when South Africa's fiscal affairs were attractive, and we were included in the World Government Bond Index and some of the Barclays aggregate indexes for bonds. We do know that we lost our investment grade, and you can clearly see the impact of that investment grade rating being lost, and the premium at which your bonds then trade above the curve and not through the curve as it's done before. However, if we look at our valuation models, we believe that over time, there has to be a strong possibility that the maintenance of fiscal discipline, which we really believe is the journey of the government, will lead to a narrowing, and that we could see appreciation in our bond yields, implying that bond yields will move lower, and therefore there will be a nice capital appreciation for our investors, and not only earning the high nominal yield, but also benefiting from a capital gain in bonds. So why are we there? So when we look at the last few years, on the left-hand side, you got the manufacturing taxes that were paid over the last few years. And we can clearly see that in COVID, many of these graphs were not very materially higher. On the right-hand side, you have the benefit that was derived by the fiscus from the mining sector. And you can clearly see that the mining sector made huge contributions to the fiscus, while manufacturing South Africa, and we all know that manufacturing South Africa, without going into the detail, have been battling. Manufacturing has shown signs of growth, but we've not really got to a position where manufacturing in South Africa is doing really well. So manufacturing is doing better from a fiscal point of view, which means companies are making better profits, which is good news. But the real dividend for the fiscus has come from the mining sector, where we saw materially higher numbers. And those bars are in rand billions. And you can clearly see the jump is really to the magnitude of close to 80 billion rand of higher numbers that we saw over the last fiscal year. Now, Kobus has mentioned to you that we obviously know oil is much higher now, and that is going to drag on the fiscus. But at the same time, coal prices have gone very much higher. And then in many cases, the commodities like iron ore, and PGMs recently spiked again, has pulled back as it looks like the world is getting to a little bit more risk-on situation. But the fact of the matter is that many of these prices are still at relatively elevated levels and will continue to provide huge fiscal dividends for government. So what does that mean? It means that the government ultimately are going to be in a position to deliver. When we look back to the beginning of this year, we saw the minister come out and making a better path for the budget, or announce a better path for the budget. When we compare that to the last year numbers, this is already an improvement. And when we go back to a time in COVID, those numbers, we must all remind ourselves, we're heading straight up to 100. So I think we have to be happy with the fact that there are serious progress in the fiscus. We do have challenges on the fiscus. I will not deny that. Obviously, government salaries, payment of social grants, spending on certain social projects will remain an elephant in the room, and will be a demand on government finances. But there's no doubt that in time, we should be moving in a favorable direction. And it might well be that South Africa in the 2022-23 fiscal year could see another big fiscal dividend, which is not fully priced for in the budget as the numbers stand today. And that graph, that is the current projection for the budget deficit, might actually move further down. That would be our view at this point in time. So when we then look at the fund, and I think this is the most important slide for people sitting on the call and then asking themselves, where are you positioned? We are slightly higher in SA equities. As indicated, we have increased our SA equity holding marginally with an overweight to banks and to commodities. And that was unfortunately done prior to the war. But if you look at how the SA equity market and the resilience with which the SA equity market has performed, I think that talks to the work that we do from a fundamental point of view and the valuation point of view by trying to ensure that we invest in markets where there's really good value on offer. Global equity markets have to a large extent been heavily impacted, and Kobus spoke about the quality growth impact that has happened in our markets. And being a quality growth investor, we are impacted by the fact that many of these value opportunities are doing better in the short term. But through the cycle, we're quite convinced that the value that we see from our international investment house, Threadneedle, in the global equity space will be to the benefit of our investors. We've spoken about the bond allocation, the LBs, and it's probably very important to then just touch on the property component on this graph. Now, we have been disinvested from property before my time, from joining the Balance franchise, which goes back to somewhere around about 2018. But as the property market went through a material correction phase late in 2020, we and unfortunately, I can say very close to the absolute bottom of the property market, we increased our exposure to property by moving from a 0 position to roughly a 6% position in property. As property recovered and moved to higher levels through 2021, we did take some of that appreciation out of the portfolio. And looking at the markets today, property certainly is still an attractive asset on a return basis, particularly some of the Eastern European property stocks, which obviously makes up a big component of SA properties, has been impacted. But when you look at the yields that these assets offer, we really are impressed by the returns that we expect. And we remain optimistic that as the world moves from a non-COVID towards a non-COVID world, that SA property will continue to see some growth. And we see even Growth Point this morning coming out with slightly increased dividends. So for the moment, we are holding property because we believe it is an asset class of interest. However, to maybe just mention to the meeting this morning, one of the asset classes that we are interrogating at the moment is global property. because as Kobus pointed out, with a much larger possible allocation globally, one wants to be very deliberate to identify and interrogate what is available in the global space. And we think that one of the asset classes that over time, once again, could deliver to the CPI +3 real return could be global property. So in conclusion, I just quickly then want to talk a little bit about performance. What I'm showing you here is the four different quartiles, the black line being the peer group, and the blue line, the rolling 3-year performance of the Balanced Cautious Fund. Now, in the very short term, this fund has been impacted because the investment style of both the domestic and the offshore equities have been impacted by what Kobus showed you in that last slide, where value has done very well in the short term. However, over time, what I think is very important is that when investors are investing in a fund, they want to be ensured that they are going to beat what they believe is the benchmark. So what I'm showing you here is the normal CPI, the CPI +3, and then the actual fund performance over a 10-year period, or slightly more than 10-year period. And I think what is important here to note is that firstly, the fund line doesn't have that much volatility. So it's not as if your market is moving in a very rapid direction up and down. And that goes back to that very first slide that I showed you today, where the drawdown of this fund has only been negative once in this 10-year period on a monthly basis. So what you can have here is a fund that does give you a good return. It's a good fund to presumably draw quite a bit of income fund from, because there's actual money coming into the fund from the property and fixed interest portion of the fund, but at the same time retain enough risk component and benefit from what we believe is as a very skilled team locally and offshore, investing in equities across a range of different asset classes, and giving you that capital growth, which we've seen the fund has delivered over time. And with that, I'm going to stop here in order to just leave a few moments for questions. Thank you very much, Donovan.
Thanks, Henk. That was great. I wonder if Kobus could come up as well. I know we did say 15 minutes, so we kind of over, but that was great content, so I really appreciate it. I thought what was interesting about your first slide, or your second slide, Henk, just around that whole bond allocation, and if you looked at the return relative to the Balanced Cautious Fund kind of given you bond-like returns, but without that bond risk. And I think the diversification benefits here is clearly demonstrated in that graph. Just around bonds, I mean, what is your interest rate views, and how do you sort of see value along that curve? I know you touched at it, but can you sort of reiterate the point around how you sort of position around the curve?
So I think we've obviously entered a global cycle of higher interest rates, and in South Africa, we obviously have not lowered interest rates to the same extent. So with the repo rate at 4%, we believe that we will potentially see another 2 to 3 hikes this year. And if you ask me where is the neutral rate that the government will be aiming to go towards, I would believe that would be around about 5.5%. Now, with inflation in the short term going up to as high as 7%, I think that the argument is still that given the structural nature of the SA economy, we believe that 4.5% is now become the neutral rate, and we believe that the way our economy operates is that that's the level it could go back towards. Obviously, materially high inflation over a longer period of time has the impact of higher labor costs. We've seen that particularly in the US, where continuous high inflation has now caused people to demand higher labor remuneration, and also labor shortages has obviously exaggerated the situation. In South Africa, we don't really have the shortage issue, maybe on the skill side. So when you look at our bond portfolio, we are in a position where we were quite long duration. And then as we approach the budget, the bond team, which we work very closely with, neutralized the duration position of the fund. And then as we moved post the budget, we saw this huge sell-off that we've seen in bonds. And on the day of the peak of the market, I was actually engaging with the bond team, and they were actually doing a little bit of buying into the market, lengthening the duration of the fund up to right about a half a year. So the bond exposure that you're looking at today is slightly long duration, which by implication mean that your actual bond position is slightly higher than the 37% that you have in the portfolio, and we're cognizant of that. Going forward, we believe that the fair value of bonds is probably, for long-dated bonds, is probably more towards 10.25, and at those kind of levels, we will potentially look to lighten our bond position. But in the light of the lack of real return in other asset classes, we really think that a very preferred area to be invested in is the bond curve, and with the duration of our bonds being around about 6.5 years, it is a relatively long duration position. But remember, investors in a fund like this are looking at a 3-year and longer time horizon, and we really think that through the cycle, the returns that you're getting from bonds would be a very a material way to achieve the CPI plus 3 outcome.
Thanks for that answer. Kobus, just a short sort of answer around quality growth. I mean, we obviously see the value run. Why, in simple, sort of 2 sentences, why do you think quality growth as a style would be better suited in a volatile market like what we're seeing right now?
Yeah, I mean, the short answer is that we just think investors will pay up for quality shares that can actually outgrow a potentially very lackluster growth environment. And that's really where it gets to, we're saying the absence of these extreme levels of fiscal stimulus and monetary stimulus that we've seen at a global level. The question is really, what kind of growth will you be encountered with, and that is corporates now, without those sort of artificially financially engineered mechanisms. And so we default back again and then say over time, and history has shown that earnings growth is your key and most important driver of shareholders' returns. Ratings on those earnings comes and goes, but it's the earnings growth that's really the sustainable driver. And we believe and are of the view that these higher quality companies will be able to deliver higher earnings growth that will ultimately deliver higher shareholders' return, especially in a world that we've moved now into, which is loaded with uncertainty and challenges.
Absolutely. And I'm just thinking about a lot of those balance sheets are a lot healthier, less leveraged as well. As in a rising interest rate environment, of course, that suits them better as well. So thanks for that. Sort of like, I think, we've got about 2 minutes left. And I'm going to ask the question that has been probably the most topical question right now from the field, my conversation with advisors, just around concerns around volatility that's entered the market. I mean, we know what's going on with Russia. We kind of spoke about it. But how do you see this portfolio holding up against a potential recessionary environment? And how do we control for the downside? I mean, it can either be Henk or yourself, Kobus. Happy.
Yeah, so I think the risk of volatility in risk assets has obviously increased. And in the event of the world going into a lower growth environment, as Kobus has rightly pointed out, it is very important that there will be a strong differentiation between which shares will do better and which shares will not, will be, call it, found out as not having sustainable earnings growth. Our view is that the kind of stock that we hold, or the style of shares that we hold, is of that nature. This portfolio obviously has a large component of yielding assets. Now, I think the property market has gone through a big readjustment, and therefore we think that even in a slightly lower growth environment, property has kind of already reflected the risks associated. So we're quite happy to keep the property block. And then we must always remember that in the event of a slowdown globally, it will probably mean that interest rates will be perceived to be going up less than originally expected. And that all plays very well for things like bonds, where bonds will then potentially be an asset class of choice, where both equity investors and conservative investors head into the bond space. So in a very serious slowdown world, bonds presumably rally, and in short, interest rates just don't go up as much. This fund does have an equity element, which we think are the kind of equities you want to hold into that environment. But will you be fully protected against a global recession? I think all asset classes will be impacted, but having a diversified portfolio, as you pointed out, is the strategy that we think is the right way. And having a conservative diversified portfolio in a world where we don't know whether we'll just have a slower growth or a materially slower growth environment must be the preferred position to be in.
Henk, thank you very much. I think that kind of sort of alludes to what the fund is all about. I guess it's trying to achieve that return with the least amount of risk. And I think that interplay between the various asset classes comes together quite nicely, and you've demonstrated that with the team over the past many years. So long may that continue, and I hope our clients found value in our presentation today. For those questions that weren't answered, we will get back to you via your STANLIB BDM in your regions. Thank you very much for attending, and all the best to you. Cheers.